All right. Good morning. Good morning, everybody. Made it through another week. Compared to yesterday, it's a pretty quiet day today. The number one thing on everybody's mind is the options expiration. I was reading through the founder's notes on Spot Gamma. Of course, these are yesterday after the close. The morning ones haven't come out yet, but the one thing that they caught my attention is that the put wall was lifted in the SPX. Um, to 4,000, and that just tightens everything up even more. So we'd been saying, for 2 weeks that the market's trapped, the bulls are trapped. They can't get through that 4,200 because every time we get anywhere close to it, the institutions and the firms are selling out of their calls that they're holding, all these long calls, and there's just so much liquidity up there, right? We run up into that zone, hit a call wall, can't make it through there, fade back away from that 4,200. Now on the bottom side, 4,000, the put wall has been brought up, so it's an even more narrow range. And then we mentioned the weekly expiration, how we're in our third week of not hitting the edge of the weekly expected move, which is really unheard of. It's never happened before that we make it through a third week without hitting the edge. So, one of these two things have to give. We're either going to break through, the put wall and hit the edge on the bottom, or we're going to break up through the top. So one or the other. All right, so we can see Hong Kong broke down yesterday, closed down. This is day number 4 for the 5-bar rule. We're still holding above the low from April 13th, so we're inside this big bar, but really in 2 weeks they've gone nowhere, still in control from the March 30 candle. That thing's still the boss, and so far got nothing. Japan also closed inside day, had a really nice recovery yesterday. Looked like they were going to keep the inside day breakout for a little bit today, and then just gave it all back again. There's still just a whole lot up here, a lot of liquidity that they can't get through. It's 12:30 in Europe. Talk about a tight range. When it does come out of this range, it's very likely going to be a monster move. But so far, they had an inside day breakout that they couldn't keep, faded back in. And when we look at all the speakers that are on the agenda, next week on the 24th, it's all European central bankers. So when we're looking at that really tight range, wondering what's going on, probably waiting on this to unfold for Europe to start moving. Today, we even have ECB twice and then one Fed speaker. But Cook is going to speak at 4:30, so it's not going to be, within our trading day. Here's the SPY spot gamma if you want to catch these levels. And the NDX and the SPX and the ES. Maybe I saved the best for last. So as you can see today, it's a very light day. Retail sales, PMI composite flash for Canada, I believe. And then our rig count, and that rig count, I wouldn't worry about that one. Maybe that's not Canada, huh? Still anticipated to be pretty low impact looking at FX Street. So we can see the cumulative volume this morning sitting at around 96. This is normal. It's within range, nothing really standing out here. If it was below 80, I'd be a little concerned. And if it was above 200, I'd be a little concerned. But, you know, sitting close to 100, it's exactly where it should be. No big deal. We just turn that thing off and get it out of the way. So you might notice all these lines on my chart. I was working on something yesterday. May come out with a video on this, but I say it constantly, watch the clock, watch the clock, watch the clock. And I'm not being silly with it. I'm serious, literally half hour on the hour. And what I've got here is just the hourly. I didn't even mark the half hour yet. What time the market moved, and it wasn't right on the dot to the minute. But when did the market change structure? Right around 10 o'clock, right around 11 o'clock, 12 o'clock. That was just a continuation. Started heading to the downside, had a nice pullback, and then continued to the downside. Just watching the clock. So when you've got your market, the S&P, the NASDAQ, whatever it is you're trading, coming into a low, and you look at the clock and realize in 2 minutes the time's going to change to a new hour, it's very likely that that new low is also going to be a support. And maybe you get a double bottom with a really nice fake breakout and then a quick reversal and a rip back up. But watch the clock. It can absolutely improve your trading. Just adding in something as simple as time, especially when you're trying to just evaluate the market. Maybe not even necessarily try to trade it yet, but trying to determine, is that high going to hold, or are we going to flip over and go down from here? Look at the time. So we've been tangled up in our daily pivot point through most of the Globex session, and we had a very narrow IB. We didn't really get too much out of the kill zone. You can see at the start of the kill zone, we were sitting basically at the Globex open. And a little rip down to 4 o'clock, and then it just reversed. Like we've talked about in liquidity vacuums, that's all this really did. And now it's trying to reverse again off of these lows, but really struggling. We do have a market maker move today, but I wouldn't read too much into it. There's not really all that much on the table other than this OpEx, right? So with such a constriction with the call wall and the put wall, there really isn't much on the table here for an anticipated anxiety of a move, right? It's going to take something seriously drastic to break us through. $4,100. And 4,200. So, you know, we can have a market maker move, sure, but if that's where the call wall and the put wall are at and today's OpEx, then you got to kind of, you know, have this expectation that we're not going to get outside of this box. Of course, that does leave a little bit of room. You know, you're talking about a 100-point move in the SPX, and we've certainly made that kind of move before. We can do it again. But after all the running around and the gyrations and everything else, there's still no expectation that we're actually going to accomplish anything today. And we're just going to try to hold the line and go into the close for the week. That's going to be the main thing. And for me, getting outside of this box is a good start. That's April 13th that we got to get out of. So it'd be a good start just getting out of that. There's a lot of threat on the table with, you know, earnings and everything else, but it's not all a downside threat. There's a lot of upside risk as well. You kind of keep that in mind. Ten-day, 30-minute volume profile. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. We were at the top. We're working our way back down to the bottom. There's really nothing to see here. We got a classic D shape. It's not a very pretty D, but it is a D. And the point of control is above us. And that's about all we have. There's no air pockets to really deal with. There's no price shelves, no help, no assistance, there's really nothing here. It's just a big wad of chewed up bubble gum. One of the things that you have to work on when it comes to technical analysis is just being able to, you know, walk away from it and say, there's nothing here, instead of trying to dig something out of it. There's nothing in that, nothing in there worth checking out. All right, we don't have a point of control from yesterday to bring forward because we've already went through that area multiple times. We do have one below us, right around that 4,100 area. And we still have one above us, 4,180. If we were to break out today, that's going to be my number one focus. So kind of thinking about that breakout, first getting above our own Globex high, then getting outside of yesterday's RTH high, and then focusing on that VPOC. All right, so we hit a new low in the VIX this week, 1616. That's phenomenally low. And again, it kind of implies that there's not a lot of risk out there, but I would argue that that it's misleading and you shouldn't approach it from that point of view. Right? There's definitely a lot of risk out there. The difference is most of these firms, you know, they had not been carrying a lot of long trades, so they didn't have anything to hedge, and so they were coming in and trading in the front end, doing their 0-day plays and all that kind of stuff. Because, well, I mean, why not? You know, they don't have anything that they need to protect. But that's changing. CTAs, you know, they're like 100% in, at least according to the CTA material that I've seen. That's a good start. It's not the only thing, right? But at some point, the VIX will eventually, you know, get back down to 12 and 14, but not this year. Just getting down into the lower end of 16 has been impressive. And I was listening to Hugh on Stock Charts TV, the Daily 5. And as he was working through his volatility models, he was suggesting that there was a potential 20 to 30% move in the VIX on the deck, like ready to go, for a lot of different reasons. And he was adamant that it's imminent. So when I was watching it, it was yesterday, which means it was filmed on Wednesday. And he was saying, it could happen within the next couple of hours, which would have been Wednesday, into the next week. So, rarely will you see an analyst, stomp their foot on a time frame like that, or slap the table, or use whatever phrase you want. They're usually more vague, and they hedge their bets by speaking both sides of the market. Well, if we break this, we could go higher, and if we break this, we could go lower. And they give you that 50-50 odds of both sides. Very rarely do you hear such an adamant table slap, but he was pretty adamant about this VIX move. If you wanted to look it up, it would just be the Stock Charts TV Daily 5. Came out Wednesday, maybe Thursday. Well, I watched it on Thursday, so it had to come out on Wednesday. Short little video, maybe 10 minutes long. So everything is just stuck in this range, from the dollar to the VIX, S&P, NASDAQ, Europe, everything, everybody, all of the major things that we're looking at. Equities, on the other hand, as a stock pickers market, there are just some absolutely amazing moves going on in equities. So definitely a trader's market for sure. Just these sectors and indexes and ETFs, and getting nothing. They did say it was going to be the sideways year, and so far, yeah, it's proven to be true. Next week's expected move. Sometimes the ES expected move is just all kinds of out of place. The market's not open yet, so we can't use the SPX. So we'll use SPY. I really think that this would give us a better reflection than the ES this morning. This indicator is not perfect. It can't read the data that it's trying to display. So the creator of this, Mobius, he did the best he could, but Thinkorswim doesn't give you access to this data using the coding. So he had to come up with these numbers a different way. I don't know. I'm kind of impressed, but it's not always accurate. And on the futures, it can get a little wonky. It's not working for SPY either. So all right. I don't like it. We'll just go back to the ES then. The reason I say I don't like it, look at this right now. For some reason, it's reading this week's this big, and it wasn't reading it that big. And now next week's just kind of looks out of place. So we'll approach it from a different point. There's a 1 standard deviation range for next week in the SPX from 42.42. I'm just doing a little rounding, 42.41.5 and 40.26.75 to the downside. So your upside and your downside move. We used a 1 standard deviation move based on time, right, for next Friday, since we don't have the expected move levels yet. And we can also come in here and look at next Friday. I know I just looked at it. 28. I'm just used to being able to see 29, the next one. These are close enough. So $70.47, at least at the moment. That's what it is. Now that's not going to be accurate as soon as the market opens, right? Because if we were to read it from where we closed yesterday, 41.29, well, the market has drifted down since then. But that's where it was as we went into the close at yesterday. And it does change through the overnight hours. So, you know, $70.47, that number has changed all night long. It's been self-adjusting and moving. According to that, a $70 move from where we closed would put us right at 4,200. See, that's $70.19. And to the downside, a $70 move would put us right at 40.60. That's a pretty tight range, 4,200 and 40.60. Next week's range is looking pretty narrow. Another mild week. We are going to be getting into the blackout period where the Fed won't be able to talk. Yellen will, though. She'll be out chipping teeth. Keep your eye on that Nick Tamaros guy, that the Fed whisperer, a Wall Street Journal reporter who the Fed likes to use when they need to communicate with us during the blackout period. All right, K-Web, pretty significant move down this morning, 1.75%. Gold down. Nat gas, emerging markets, tech. Might be easier just to say what is up this morning, because even Bitcoin is flat to negative. Financials, we got nothing really. Got some staples and a little bit of healthcare this morning. So defensive names are up just a little bit. And that, I mean, that's all we've got is a little bit of defense. I think it's going to be a very boring, very slow, choppy, nasty day. And I can't say for sure that I'm even going to want to mess around with it. So a little bit of guidance here. If you don't want to trade a choppy mess, you could set your edges, wait for price to get out of that, and then trade. So a good rule of thumb to start with is if we're inside of this Globex range when we get into the RTH session, then it's going to be difficult to trade, choppy and nasty. So you can just start with that. Just draw a box, project it forward into today's trading. As we get into the RTH, if we're inside this, you're going to find it hard to trade. One level out from that, if we are inside of yesterday's price action, you're going to find it difficult to trade. Now, I'm not saying that you shouldn't do it or that it's impossible to do. Heck no. And I've seen really good trading days where we were inside a previous day and yet today was still a really good day. So it's no guarantee that it's going to be trash, but a good rule of thumb, if we're inside of our own Globex in the RTH, it's going to be hard to trade. It's going to be choppy and difficult, and nasty. And if we're inside of yesterday's range, it again will be choppy, difficult, and nasty. RTH, regular trading hours. RTH. Globex is what isn't the RTH. So this darker shaded area on my chart, that was the regular trading hours from 9:30 to 4. And when I say Globex, I mean everything that isn't the RTH. Yeah, there's always another acronym, right? Or another set of letters to learn. And I have a hard time keeping up with them all. So that's a good rule of thumb that can carry you a long ways, especially if you're having trouble day trading and you're finding it difficult. Quit doing the hard stuff. And that would be one of the things that you would want to quit doing. Between not trading inside of our own Globex and watching the clock, avoiding trading between 8 and 10 in the morning, you can drastically reduce your losses, which means you can start winning more often. Really good start to something just as simple as patience and self-control, a little bit of restraint, all the difference in the world. For swing trades, there's still not enough risk to reward for the indexes to look for any long opportunities or even to try to short, right? It's not weak enough to short, and we've been holding here too long to want to try to trade a long trade until we actually get a breakout. Everything should be different next week because we'll be out of the OpEx that has been holding us back for weeks. So that's a really big deal. And I would just look forward to that. You know, take the opportunity to go out to the daily chart, the weekly chart, the monthly chart, and really review some of the names that you like the most to trade. Last year, I traded finance and energy a lot. They were the things that to trade, short duration stuff. They're not overly expensive, so my littler accounts can hold it. And just short-term trades, intraday trades, intra-week trades. A lot of opportunities with energy names and financial names. Now with the banking crisis, I'm not so excited about a lot of those smaller energy or financials, but still. So Tesla had a significant change in stock price, right? And then of course the SpaceX rocket blowing up sure didn't help old Elon any. But it's funny, he blew it up. I was listening to the report on this whole thing. That booster was supposed to detach from the rocket and it didn't. And so it was sending the rocket spiraling and out of control. And so they detonated the thing to make sure it wouldn't hurt anybody, right? It wouldn't come crashing back down to Earth somewhere. Like, could you imagine hitting a major city with that, right? So they exploded the darn thing. How'd you like to be the person to push that button, right? So after an earnings event like this, you got to give the market a little bit of time to stabilize. And when it comes to technical analysis, performing analysis on a gapped market or a market that has just done something that was unexpected, it breaks the chart. So you don't want to try to perform technical analysis on it as like, oh, well, where are we going to go from here? Not for a couple of days at least, especially if you listen to something like Stock Charts TV or IBD. IBD hits this a lot, the health of a chart. So if you get a chart that makes a significant change, big parabolic move, massive gap, something like that, it breaks the chart. It breaks all the patterns. And now you have to wait for it to clean itself up, to heal, and then to give you something that's trustworthy and readable again. The whole idea is with technical analysis is that you're looking in the past for examples of something that you've seen before, right? Or you're looking at it now and trying to gauge its current price with something that it's had before. But once it breaks and it does something really bad, it has to heal before you can get any trustworthy analysis out of it. So really keep that in mind, that technical analysis just can't be used whenever you want, all the time, anytime, anywhere, always. So we can still do it, but don't trust it as much. Really reduce your position size, maybe grow it in a little bit at a time, and start with small things, small time frames. Where Tesla would go today, I would use the hourly. Where it's going to go next week, I would use the weekly close. So keep your time frames really small, and little by little, let it heal, and then your trust can come back a lot more. With this, and the same thing was said about Apple, not even 6 months ago, when Apple had a really bad move to the downside. I heard, oh, that's it, Apple's busted. It's not going to see these highs again for forever, for a long time, a decade, 5 years, and it's already back up to these levels. So, really approach Tesla with some caution. It is still a beloved product, not necessarily by the institutions anymore, but it has a cult following of traders. So if you guys remember, Apple had some pretty negative news a few times last year. And I can't tell you how often I heard, that's it, it's busted, it's not coming back, we're not going to see these levels again. We're right back up near the high. So with Tesla, it's down now, yes, and the sentiment is pretty negative, yes. And I've already heard, that's it, it's busted, it's not coming back anytime soon. Now see these levels again, blah blah blah. Approach with caution. I heard it about Nvidia too last year. So for the week, which is what we're looking at right here, consider how the week is going to close. If we can close like this, down like this, where we open next week will become very important. Do we gap down next week? Do we gap up next week? If we gap down, I'll probably look for a small trade to the upside, maybe back into at least 50% of this candle around that 174, 175 area. And if we gap up on Monday, then I'm going to probably look for a short once we break this week's low for a continuation lower. Does that make sense? That'd be my plan. For an example of why, think of this here, where we closed here, and on that Monday we opened gapped up, and then we broke the previous week's low, and we continued to the downside. So if we open gapped up next week, I'll be looking for a break of the low and then a continuation to the downside. If we open gapped down next week, I'm going to look to get at least 50% of this week's candle in a long move, because that would imply that we would open, say down here somewhere, and that would be a pretty decent run back up to about 50% of that candle. Like it? I like it. That's my plan. To kind of get a visual on what that would look like, we have it right here where we closed the week there. We opened a new week, gapped down, and we ran back up 50% of the previous week's candle, right? So that would be an example if we gap down what I'm planning to do. And this would be the example of the plan to go short if we gap up. Cool, cool. And I wouldn't play it any farther out than that. You know what I mean? Like, because the chart is still broken, at least on the smaller time frames like the daily, I wouldn't approach it any closer than that, or try to swing it for any longer than that. And then, you know, maybe go down to the hourly and the 30 and the 15 for some intraday trading, that kind of thing. Speaking of Apple, some craziness here. I don't know if you guys listen to that Stock Charts TV, but they do a lot of market breadth stuff. And it's a nice noise in the background if you're, you know, like, say, working. When I'm in the kitchen baking cookies, I'll turn on Stock Charts TV and have it on just like a podcast kind of thing in the background. Pick up a lot of insights on breadth tools like McClellan Summation Index and things like that, right? Just like these old school breadth indicators, and they do a lot of breadth talk on that show, and I like that kind of background. You certainly don't get enough out of that on, you know, like just YouTube, the typical chit chatty. Everybody wants to focus on the most immediate hot topic thing, and I don't know. If you haven't listened to it, you should. It's free. Doesn't cost you anything. Not that free. So Apple's got this wedge here, and really it shouldn't have got that close to the edge of the wedge. I'm so shocked that we haven't broke out of this thing yet. But the market can't stay here, right? So it's just like the old song says, I don't care where you go, you got to get out of here. So Apple's got to get out of this box. And that might seem obvious, but with this kind of compression, the getting out of the box might not be so gentle. Looking at how we close this week, it's not going to be something really good like an evening star reversal play or a 3-bar reversal or a swing high setup. It's not looking like it's going to be anything like that. I would also caution a little bit that if we do break to the upside, approach with caution. When we get a rising wedge like this, we sometimes get a parabolic move out of the top first, and then it dumps, especially if it's gone too far inside the apex of the wedge. So look for that, because basically what we're discussing is it gets into a squeeze, and so then we get that parabolic rip up, and then they spring the trap on the bulls, get them to puke, and then we dump down. So if we do break out of this to the upside next week, that does not automatically trigger a rise to this distance, right? Because that's how we're going to plot our target to the upside. But we're on a weekly chart, and I would say, you know, missing 1 week, if you were just to monitor the breakout on the first week and not necessarily trade it, or at least just get in with a small position, let that week close, see the new week open, and see if it's going to dump down. Of course, if it starts to the downside and doesn't go up, it happens. But more often than not, what I see if it breaks down and then it starts to go up is that it just busbees off the bottom, right? So it'll rebound up, hit its head, maybe break up inside, and then it'll still continue to go down. So we don't really get those fake outs down and then the rip up, I'm sure I could find an example somewhere, but it's a rare thing for that. But it's more common to see a fake breakout up first and then the down move. And we're still looking at Apple above 200 or close to 200 for that measured move. If it does break out and continue to go, we'd get through that August high and get really above the 2022 high, that December, January high of right before the whole bear market thing kicked in. And with them, all that news about them moving into India and opening stores and having a whole new market to focus on, I can absolutely see this thing, getting up into 250s, 280s, not this year, but as a reason to buy and hold Apple for a longer term. I've heard people say it's toast, it's done. We're going to be looking for new leaders in technology and, what's going to be the next Apple. And right now, Apple is going to be the next Apple. Microsoft is still dealing with this wedge. How we open next week is going to be more important to me than anything else. So closing this week, yeah, I mean, with the put and call wall that we've already discussed, I'm not really all that anxious about the close. I'm more anxious about how we open next week. It has a long ways to go compared to Apple to get back, to the pre-bear market levels. We're still negotiating with that August high. That is the level, the line in the sand for a lot of markets out there right now. Just getting through that. You see on the S&P, it's the line in the sand we haven't been able to get through. And we can't even get back up to that because of that 4,200 wall. All right, NVIDIA still can't count this thing out. We did see a lot of moves in semis yesterday, but as someone way smarter than me said, I wouldn't trust semis right now at all. I don't care how good it looks, but that doesn't mean we can't trade them, right? Just I wouldn't take any long-term trades long in these things, but for day trades and short-term trades, oh yeah, why not? So with NVIDIA, a little bit of gap down, but for the week, considering how we're going to close this week, this thing's still not a short. I know everybody out there, including me, would love to short this thing right into the dirt, but not yet. Looking at it on the daily, you got to kind of believe that it can't stay, right? It can't keep this up for much longer. Very likely going to retest these lows. Could overshoot a little bit just to get a little bear trap, suck everybody in, and then rip it back up again. We'll see. I was hoping that Tier 1 Alpha would come out with their email while I was still streaming, but nope. All right, so we do have the gap closed here from the 17th. We're going to be opening, it looks like, inside of this candle. Oh yeah, we're trying to break back out of it right now. So we're inside day breakout in NVIDIA. If we can get back inside of NVIDIA's yesterday's price, then we could aim for at least 50% of yesterday's move, right? So around 275. You just measure that on the daily. Yeah, 275.15. If we reject off of the bottom here, then 265, the bottom of this range, would be what I would focus on for a short play. But only that, right? It's not like we're looking for NVIDIA to break down and really be a great short. Not yet. So I'm not excited about AMD at all. We're not broke down below yesterday's levels, and we don't have an inside day breakout to the upside either. Just getting that much, I think, would take most of the energy out of this thing, and there wouldn't be anything left for a rally. Having said that, we do have the setup for that machine gun reversal. They really got to come up with a better name for that, right? So look for AMD to break out of yesterday's range, either up or down. For a downside move, that's actually a pretty strong level of support. So if we were to break that level, I think we could get it quite a bit out of it. Let's use the quant tool here. Oh yeah, 86 would not be out of line even for today if we were to get a downside breakout. Got to get below that 88.5, but if you could get outside of that, then it's game on. 87 and then 85 today. But so far, it's not looking like it's going to get outside of yesterday's level. All right, Meta was on Seeking Alpha's list of 2023 names to watch for bullish moves. It was a contrarian list at the time. It came out in December. It was, for this year. Netflix and Meta were two names that were on the list for contrarian plays. And I mean, what a call, right? They called it when it was still in December. So, around that 110 area. We're at 210 in 3 months, 4 months. Yeah, pretty impressive. But we got this significant level of resistance. And I like how this week was a red week. Just kind of consolidating, keeping the chart healthy. It's not some crazy runaway market. We get a more appropriate risk to reward if we can get some two-sided price action, right? A nice little pullback here. And as long as we maintain above $200, then it's still healthy. And I would continue to focus on this thing for long plays. Not today, right? Not today. Today, the short play would be down to 209. I guess we're already down to 209. It beat me to it. Let's see. 208.65. If we can get below that, we could try to half the box, I guess. Let's see. 202, be headed towards $200. Not today, right? We've already gapped down in Meta this morning to 209. So right above this line, we're that low. The concern after this much of a drop is that it will go back up. bounce on support, rally up into resistance before continuing the move to the downside. So that kind of sets us up nice. When we come into the RTH today, if we rally and break above 211, I could see a play getting back to, say, 50% of yesterday's price. 215, 211 to 215. It's not a bad move for a day trade. At the very least, if we come into the RTH and we open and it just doesn't break lower for a 0-day trade, putting on a put credit spread at the day's low. You see that too. So those China names are really getting whacked. PDD, JD, Baba, Baidu. Keep your eye on NEO today. We could break yesterday's low. It'd be a nice continuation. 750 would be the target to the downside here on NEO. Otherwise, if we start to rally back up, just getting to yesterday's open would be impressive. It'd been 9.5. It's not bad. We're at 8:30 in the pre-market, so everybody try to get something useful out of today. I guess it's going to be a sideways day in the indexes, but again, it's a stock pickers market right now for sure. So, focus on the equity names that are at least moving around doing something. Otherwise, I don't know, maybe take a day to make some cookies. Have a good weekend, everyone. Be careful, be safe. I'll see you all next week.